In March of the year 2000, two men sat in front of computer monitors in the United States, watching the exact same stock ticker tape. The Nasdaq Composite had just crossed the 5,000 mark. The financial world was in a state of absolute euphoria. A 34-year-old software engineer living in Seattle, David was the embodiment of the new economy. He believed the old rules of valuation were dead. Over the previous 18 months, he had liquidated his conservative retirement accounts, taken out a second mortgage on his home, and used margin debt to pour every available dollar into internet startups. His portfolio was heavily concentrated in companies with no profits, no revenue, and no physical assets, but with a doublequotes.com appended to their names. On March 10th, 2000, David's brokerage account showed a peak paper value of $840,000. He was, on paper, a millionaire. He had beaten the system. He had secured his family's future. The second man was Elias Thorne, a 52-year-old value fund manager operating out of a quiet, wood-paneled office in Chicago. Elias looked at the exact same ticker tape, but he did not see a new paradigm. He saw a mathematical impossibility. He saw a market where the aggregate price-to-sales ratio of the technology sector had detached from historical reality. Elias did not trust the momentum. He understood that gravity always eventually reasserts itself in financial markets. So, Elias did something that, to the average investor at the time, looked like absolute financial suicide. He completely liquidated his equity positions. He moved his entire fund into short-term treasury bills and had municipal bonds, yielding a modest 6%. He held zero tech stocks. He held zero exposure to the new economy. Both men were operating in the exact same macroeconomic environment. Both men had access to the exact same information. Fast forward exactly 31 months to October of 2002. David Miller sat in his car outside a foreclosure notice on his Seattle home. The Nasdaq had lost 78% of its value. The specific internet stocks he had bought on margin had not just fallen. They had gone to zero. His $840,000 in paper wealth had been wiped out, and the margin debt remained. He was not just broke. He was deeply in the negative. He had lost his house, his savings, and his career. The psychological toll was absolute. Elias Thorne, on the other hand, sat in his office reviewing his fund's quarterly performance. During the crash, while the speculative tech sector was burning to the ground, Elias had systematically deployed his treasury capital into unloved, cash-flowing legacy businesses. He bought regional waste management companies, mature industrial suppliers, and established financial institutions at 40 cents on the dollar. Because he had preserved his capital, he was the only buyer in a market devoid of liquidity. By the end of 2002, his fund was up 40%, while the rest of the world was bleeding. By 2005, his fund had multiplied threefold. He had not just survived the crash, he had used it to build a generational fortress of wealth. Same market crash, same time frame, same country. One man was financially destroyed, the other was immortalized. Dosam pattern interruption. What happened here was not random. It was not a matter of bad luck. And David Miller did not simply make a few bad stock picks. He fell victim to a systemic trap that is engineered into the very architecture of financial markets. He did exactly what the financial media, the brokers, and the cultural zeitgeist told him to do. He chased momentum. He bought the narrative. The tragedy of David Miller is the tragedy of the retail investor. It is the realization that participating in a bull market does not mean you understand how the market works. What most people miss when they look at the dot-com crash of 2000 is that the destruction of retail wealth was not a bug in the economic system. It was a feature. The system required the liquidation of the late stage speculator to provide the liquidity necessary for the next cycle. The wealth did not simply vanish into thin air. It was transferred. It was moved from the accounts of the impatient to the portfolios of the positioned. To understand how this happens, And more importantly, to understand how it is happening right now, we have to stop looking at market crashes as random acts of financial violence. We have to look at them as a machine. And once you see the gears turning, you can never unsee them. 3. Introduce the mechanism. I call this mechanism the Capital Displacement Mechanism. It is vital to understand the terminology here. The mainstream financial narrative will tell you that during a crash, wealth is destroyed. They will show you charts of the stock market going down and tell you that trillions of dollars have evaporated. But that is a fundamental misdiagnosis of the physics of money. Capital is never destroyed. It is merely displaced. The capital displacement mechanism is not a destruction mechanism. It is a transfer mechanism. It is a structural process by which a highly leveraged, speculative market corrects itself by forcibly moving capital from overvalued, speculative assets into undervalued, cash-flowing assets. It moves wealth from the momentum chaser to the value accumulator. It moves wealth from the speculative sector to the structural sector. The mechanism operates quietly during the bull market, building up the pressure. But when the crash occurs, it operates violently. It creates a liquidity vacuum. When the speculative bubble bursts, the capital trapped in that sector is either destroyed or forced to flee. That fleeing capital, combined with the dry powder held by patient investors, creates a massive displacement of purchasing power. The smart money does not just buy the dip. They use the displacement mechanism to acquire real, cash-flowing assets at a fraction of their intrinsic value, while the rest of the market is forced to sell at any price to meet margin calls. *** 4. Break down into steps. Phases. ***. The capital displacement mechanism does not happen overnight. It is a deliberate, multi-phase process. To understand how smart investors use the 2000.com failure to build wealth, we must break this mechanism down into its 4 distinct phases. Phase 1. The euphoria and the illusion of permanence. For the displacement mechanism to eventually work, the public must first believe that the current speculative asset class is immune to gravity. In the late 1990s, the internet was a genuine technological revolution, but the market priced it as an immediate, linear exponential curve. The cost of capital was low, and the narrative of the new economy convinced retail investors that traditional metrics like and free cash flow were obsolete. Human psychology is wired to extrapolate recent trends into infinity. During this phase, the smart money is quietly distributing their shares to the retail crowd. The smart money knows the valuation is absurd, but they also know the crowd's greed is a powerful force. They sell into the strength, converting their speculative paper wealth into cold, hard cash. They are building the dry powder required for Phase 3. Phase 2. The liquidity trap and the margin call. The mechanism is triggered when the narrative collides with reality. In early 2000, interest rates began to rise, and the expected exponential profits of the dot-com companies failed to materialize. The illusion broke. This is where the mechanism becomes violent. As prices begin to fall, the leverage embedded in the system is exposed. Retail investors who bought on margin receive margin calls. They are forced to sell their assets, regardless of the price, to meet their debt obligations. This creates a feedback loop of forced selling. The smart money, already in cash or holding short positions, watches as the speculative sector collapses under the weight of its own leverage. The capital in this sector is trapped. It cannot flow anywhere until the leverage is flushed out. Phase 3. The valuation vacuum. This is the critical phase where the actual transfer of wealth occurs. As the speculative sector crashes, a valuation vacuum is created. The media declares that the entire stock market is dead. Panic sets in. Human behavior shifts from extreme greed to extreme fear. Investors indiscriminately sell everything, including high-quality, cash-flowing legacy businesses, simply to raise cash or cover losses in their speculative positions. This is where the smart money strikes. They do not buy the crashed dot-com stocks. They recognize that the vacuum has dragged down the prices of fundamentally sound assets. They deploy their preserved capital to buy unloved, tangible businesses, companies that produce real cash flow, pay dividends, and have hard assets at massive discounts. Phase 4. The displacement and the accumulation. Once the speculative sector is fully flushed and the leverage is cleared, the displaced capital begins to flow back into the market. But it does not flow back into the same speculative assets that caused the crash. The smart money has already accumulated the best assets at the bottom. As the economy recovers, the cash-flowing assets they bought in Phase 3 begin to re-rate to their proper valuations. The retail investor, traumatized and broke, misses the entire recovery. The smart money, having acquired real assets for pennies on the dollar, captures the vast majority of the upside. The wealth transfer is complete. The capital has been successfully displaced from the speculative hands of the many to the structural hands of the few. 5. Historical proof. It is easy to look at the dot-com crash and dismiss it as a unique anomaly, a once-in-a-lifetime perfect storm of internet hype and Y2K panic. But the data shows that the capital displacement mechanism is not an anomaly. It is a recurring historical pattern. Whenever a speculative bubble reaches its mathematical limit, this exact mechanism is deployed. Let us look at the historical proof. Consider the year 1929. The United States was in the depths of the roaring 20s. The public was leveraged to the hilt buying radio and automobile stocks on margin. When the crash hit, the speculative sector was obliterated. The Dow Jones Industrial Average eventually fell by 89%. The retail investor was destroyed. But what did the smart money do? They did not buy the crashed radio stocks. They used the valuation vacuum to accumulate utility companies, consumer staples, and industrial monopolies that were trading at dividend yields of 8 or 9%. When the dust settled in the 1930s, the speculative stocks of the 1920s never recovered, but the cash-flowing legacy assets accumulated. By the smart money during the crash generated massive wealth. Over the next 3 decades, same crash. Different outcome for the positioned. Now, fast forward to the great financial crisis of 2008. The mechanics were different, but the outcome was identical. The speculative bubble was in residential, real estate, and the mortgage-backed securities derived from them. When the housing bubble burst, the middle class lost their primary asset. Millions were foreclosed upon. To prevent a total systemic collapse, the financial system seized up. The valuation vacuum was absolute. The smart money investors, like Warren Buffett, who injected capital into Goldman Sachs at a massive premium, and private equity firms that bought billions of dollars in real estate 4 cents on the dollar, used the displacement mechanism. They did not buy the toxic subprime assets. They bought high-quality financial institutions and physical real estate at a devastating discount. Over the next decade, while the middle class struggled with stagnant wages, the top 1%, who owned these displaced assets, saw their net worth explode. The data shows a massive divergence. The crisis was the catalyst. The displacement was the mechanism. Finally, look at the events of 2020. The pandemic response triggered a sudden, violent economic shutdown. The stock market crashed 34% in a single month. The narrative was that travel, energy, and financial stocks were dead. The valuation vacuum dragged down the entire market. But the smart money looked at the displacement. They recognized that the energy sector was fundamentally under, and that financial institutions were vastly stronger than in 2008. They deployed capital into beaten-down energy majors and regional banks over the next 3 years, while the high-flying tech stocks of the 2020 boom eventually collapsed. The unloved value stocks accumulated during the March 2020 panic outperformed the broader market by a wide margin. This always happens. The asset class changes. The geopolitical trigger changes, but the mechanical transfer of wealth from the speculative holder to the structural accumulator remains a constant law of financial physics. Says and return to present. Right now, we are in the late stages of a remarkably similar cycle. Look at the current market environment. We are experiencing a massive concentration in a single sector: artificial intelligence and megacap technology. The narrative is identical to the late 1990s, the mainstream financial media tells you that AI is a new paradigm, that traditional valuations no longer apply, and that these few companies will grow exponentially forever. The aggregate price-to-sales ratio of the top 10 technology stocks is approaching the extreme levels seen in March 2000. This is where it gets important. We are currently in Phase 1, transitioning into Phase 2 of the Capital Displacement Mechanism. The smart money is not sitting in cash, doing nothing. They are quietly executing the distribution phase. They are selling the speculative tech stocks to the retail crowd, who are chasing the AI narrative via ETFs and options. The smart money is taking that capital and moving it into the shadows. They are accumulating unloved, cash-flowing sectors, energy infrastructure, materials, small cap value, and physical commodities. They are building the dry powder. When the narrative eventually collides with reality, when interest rates remain structurally higher, or when the massive capital expenditures in AI fail to produce immediate exponential returns, the liquidity trap will spring. The speculative tech sector will experience a violent correction. The valuation vacuum will open, and the smart money, holding the accumulated dry powder and positioned in real assets, will deploy their capital to buy the next generation of cash-flowing businesses at a massive discount. The system is working exactly as it is designed to work. Siete signos to wash. You do not need to be a macroeconomic genius to see the capital displacement mechanism in action. You just need to know where to look. There are 3 measurable indicators that show the mechanism is currently active and preparing for the next phase. The first signal is market breadth and the equal weight divergence. Track the standard S&P 500 index against the S&P 500 equal weight index. In a healthy market, both rise together. In the late stages of a speculative bubble, the market becomes incredibly narrow. The cap-weighted index is driven entirely by a handful of mega-cap tech stocks, while the equal-weight index, which gives the same weight to a small industrial company as it does to a tech giant, stagnates or falls. When this divergence reaches historical extremes, it is a mathematical confirmation that the market is top-heavy and the speculative sector is masking the weakness in the broader economy. The vacuum is preparing to form. The second signal is the high-yield credit spread. This is the difference in yield between speculative junk bonds and safe US treasuries during a bull market. This spread is tight because investors are willing to take on risk for minimal reward. But when the liquidity trap begins to spring and companies with high debt loads struggle to refinance, this spread begins to widen rapidly. When the high-yield spread starts to expand, it means the smart money is demanding a higher premium for risk. It is the early warning system that the margin calls are beginning, and the forced selling phase is imminent. The third signal is the cash position of institutional investors, and the put-call ratio. Track the percentage of assets that mutual funds and institutional investors are holding in cash. During peak euphoria, cash positions drop to historical lows because being in cash feels like a drag on performance. But right before a major displacement event, you will often see a divergence. While retail investors are fully invested and borrowing on margin, smart institutional money begins to quietly raise its cash levels. Concurrently, watch the options market. If the put-call ratio remains complacently low, while the market is making new highs, it means the crowd is entirely unhedged. When the smart money is raising cash and the crowd is fully exposed, the conditions for a massive capital displacement are perfectly set. Asterisk 8. Return to original story. Asterisk. Let us return to David Miller and Elias Thorne. But let us look at where they are today. More than 2 decades after the dot-com crash, David Miller never fully recovered from the psychological and financial devastation of 2002. He spent the next 10 years working multiple jobs just to pay off the margin debt and rebuild a fraction of his lost retirement savings. He eventually retired in his late 60s, living on a modest social security check. Every time the stock market experiences a volatility spike, he feels a physical tightening in his chest. He was the victim of the Capital Displacement Mechanism. His wealth was not just lost. It was systematically transferred to someone else because he did not understand the rules of the machine. Elias Thorne, on the other hand, retired in 2008. The wealth he accumulated by buying cash legacy businesses during the 2002 valuation vacuum compounded beautifully over the next 2 decades. He didn't just survive the 2008 financial crisis, he used the exact same displacement mechanism to acquire more assets when the world was panicking. He built a fortress of generational wealth that is now managed by a family office for his grandchildren. He understood that the dollar was a melting ice cube and that speculative tech stocks were a casino, so he built his portfolio out of tangible, cash-flowing assets that could not be wiped out by a margin call. The tragedy of this story is not that Elias Thorne got rich. Wealth creation and accumulation are natural parts of a functioning economic system. The tragedy is that David Miller was penalized for his ignorance. The system required a victim to absorb the cost of the speculative excess, and David, with his margin debt and his blind faith in the narrative, was the perfect, willing victim. Nueve and final message. The lesson of the 2000.com. Failure is not a lesson about how to pick the right stocks or how to time the exact bottom of a crash. It is a fundamental lesson about the architecture of the financial system. The market, in its modern form, is not a random walk. It is a mechanism of capital displacement. It is a tool designed to facilitate the transfer of resources from those who speculate and chase momentum to those who analyze and accumulate structure. The capital displacement mechanism is not a glitch in this system. It is the primary function of it. When you understand this, your entire perspective on wealth changes. You stop looking at the nominal price of a stock and start looking at the underlying cash flow and the valuation vacuum. You stop asking what the market will do tomorrow and start asking where the capital is being displaced when the music stops. The data shows the pattern. History shows the outcome. The only variable left is whether you choose to be the victim of the displacement or whether you choose to position yourself on the receiving end of the mechanism. If this gave you a new framework for understanding the hidden architecture of market crashes and wealth transfer, consider sharing it with someone who needs to see the machine for what it really is. The system relies on our ignorance. Understanding the pattern is the first step to protecting your future.